A lot of silver is used in industrial products. If the world does not have silver for industry, things start shutting down. All electronics, medical, military applications, lasers, you name it, silver is used in a lot of things. And I think that we're coming to a crisis point in which we do not have enough physical silver being produced, and we do not have enough above ground inventories, that there's going to be some sort of supply shock on the market, and companies and businesses are going to have to start making alternative plans.
Hi, I'm Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special for October 4th through October 11th, 2022. This week we feature a very special silver buffalo at only $4 over spot while this shipment lasts. These 1-ounce silver rounds are made by Bull Mint in Bulgaria, a mint distinguishing themselves by raising the bar not only on purity and quality, but on artistic merit. So you'll see that these are buffalo rounds reimagined, with 4/9 fine purity instead of the traditional 3, as well as a new portrait on the obverse and dueling bison on the reverse. They come in tubes of 20 and what Bull Mint calls master boxes of 400. Again, these rounds are available at $4 over spot for a very limited time. Our number for all orders is 1-888-81-LIBERTY. It's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Robert Kientz from GoldSilverPros. Robert, thank you so much for joining us today.
Happy to be here, Elijah. Thanks for having me.
Well, it's great to have you. And I wanted to discuss the giant move we saw, the big move in silver that we saw on Monday. If you could kind of shine light on that and what made silver rise so much as well as gold.
Well, I think what's doing it was the expectation on not only what the Fed's going to do, but what employment looked like. So the first week of the month, of every month, is non-farm payrolls report. And given that ADP, which is a preview of the non-farm payrolls, it comes out on Wednesday. It's a private version of it, of what the BLS will put out on the first Friday of the month. They had changed their methodology to be more like the BLS methodology, and they were reporting an expectation of 208,000 jobs to be created. The BLS report came out today, and it was released about 8:30 this morning, and it had payrolls increasing 263,000 for the month. That was a pretty healthy number. The official employment rate's down to 3.5%, although labor force participation rate has actually fallen off. That's a longer-term measure of the healthy employment in the U.S. It's now at 62.3%, which is still about a percentage less than the overall employment rate we had prior to the Great Recession. So we've actually lost about a percentage of Americans working in the economy over the last 13 years. So even though the employment numbers quoted are pretty good, and that's caused gold and silver to have a little bit of a correction today, which is normal, overall, the overall labor force participation rate and the job situation really hasn't improved for the last 13 years. And so I don't expect the payrolls report that came out this week to negatively affect gold and silver long term. I think it'll continue to move up, and this is really just a blip on the radar.
Now, you're saying from here, you're still looking for precious metals to move up in the short term?
Yeah, I do think that they'll continue to move up. I mean, if you look at what's driving it, we'll just talk about the physical trade on silver. There are a lot of shortages being reported by a lot of wholesalers. I talked to a couple of wholesalers last Saturday. One of them mentioned they're about 99% out of silver stock and that premiums are rising. Of course, we know we've had all-time highs in silver premiums as a percentage of price going on for quite a while now, because while the physical demand for silver and gold is very, very strong, and there aren't a lot of, especially in silver, a lot of above ground stockpiles left, there is a lot of selling pressure in the derivative markets. So physical demand for gold and silver very strong, selling pressure in the derivative markets. And I think the selling pressure in derivative markets is much the same as in the rest of the markets. It's a liquidity-driven event in which people basically need money as the economic conditions deteriorate. So a lot of the derivative products like silver and gold-based ETFs and the derivative trade on the futures and options market are going to be continue to have some overall weakness the last few months. But given the fact that we have such shortages and the world is starting to notice on the silver front, I think silver price is probably going to move up higher than gold over the next few months. And I think what will drive gold is really paying attention to what the Fed does with this jobs report that we just got being more positive than expected, I think the Fed is going to continue its path of raising rates. They're not going to pivot and go more to quantitative easing. They're going to raise rates, and I think that is long-term, both medium and long-term bullish for both gold and silver. But expect to see silver make a little bit more of a volatile move to the upside due to expected concerns with the actual physical inventories. I think we're down to something like 41 million ounces of available silver, and the registered category is still available on COMEX. There was a story out in the past week that if you look at LBMA silver, or the silver on the London OTC market, that's also been run off quite a bit. So the available world stocks that we know about reported on the two major Western exchanges are draining off. And I think that's going to cause silver to be a little bit more bullish over the next month to two than gold. But I do expect both of them to continue to move upwards.
What you're seeing, obviously, in the wholesale market is exactly what we're hearing as well from the major wholesalers out there. But it seems like what you're saying is actually the physical market is going to be moving the price now. So typically we talked about a lot of the futures contracts. That's what is the main impact, the main thing that impacts the price. But in this case, it's actually people taking delivery and buying retail product that's going to be moving the price now.
Yeah, essentially, if you look at what the derivative markets are, if you're investing in SLV or GLD as an ETF format, like a managed money trader would for their clients, or if you're on the derivative markets and you're either price hedging or speculating there, as a lot of the big managed money houses do, bullion banks do, producer merchants do, whichever one you look at, there has been a lot of selling pressure on the precious metals. But that's just basically essentially gambling on what they think the futures price for those products is going to be in the next 2 to 3 months. So while the COMEX and London OTC markets tend to determine the spot price of gold and silver, a lot of it just has to do with expectations on where it could go. It doesn't actually reflect what's going on in the physical market. Because remember, Elijah, on the COMEX, most contracts are never what they call cash or physically settled into real physical product. It does happen, and there has been a lot, and that's how the silver and gold have been taken off of the COMEX. But the vast majority of contracts in the open interest and the settled ones in the volume category are basically rolling over contracts to a new month and basically resetting the bet, or sometimes cash settlement, and in a very few cases, physical delivery. That's why the prices of the ETFs that the managed money invests in and the derivative products really don't give you an idea of what's going on in the physical market, because they're not paying attention to it. Those aren't physical markets. An SLV and GLD, for example, you cannot redeem your shares for gold or silver unless you're one of the authorized participants. And that's one of the big bullion houses and bullion banks that supplies the gold and silver to those funds. So in the case of those products price can be moving down, even though the physical trade is really strong. Now, to answer your question, I do believe there are times at which, however, the news of physical shortages reaches those traders, and certainly they're paying attention to that now. And so I think what happens is traders eventually will change their opinion on their investments in gold and silver and their price targets on gold and silver as the silver squeeze and silver shortage story continues to build momentum, since it has, dating back to January, February of last year. And I also believe as we continue to have economic problems, the Fed raising rates, a lot of the central banks aligning coordinated policy to deal with the current recession that we have, and as that economic data deteriorates, I think that's going to push gold up more and more over the short to medium term. So I think we're in a period in which gold and silver are probably likely mostly to move up until the end of the year. We'll reset on the love trade in China and India in January after their physical demand for their cultural need for gold and silver that they have in those countries. And we'll see again in January what happens. But I do expect, because of the love trade, the physical demand, and the fact that people are starting to follow silver even in the mainstream media, and the shortages are going to continue to push up the precious metals to the end of the year. I'd be surprised if they weren't.
No, it seems like this is kind of a silver squeeze 2.0. I know we've discussed this in the past, and you had said, a month ago or so when we had you on that, this has started, and it seems like you're right, because we are seeing such shortage in retail product right now.
Yeah, as one of my good friends puts it, a silver squeeze is a movement, and it's something that's been occurring dating back to last year. And as I've noted in a lot of videos and articles I've been putting out lately, silver has been running off of the major exchanges and has been running out of most of the silver ETF funds dating back to the original silver squeeze. This is something I predicted during the original silver squeeze. I said, you know what? The original silver squeeze was people coming into SLV in a broad ETF passive format which ended up liquidating about 110 million ounces of silver out of the London OTC market into the SLV coffers. That's where they store most of their silver. Some stored in New York, but the vast majority is stored in the UK. And what happened was LBMA came out a couple of months later and said if that had continued, investors had continued to invest in this SLV ETF, we would have run out of all available free-floating physical silver in the London market. It would have drained the entire market, which doesn't just serve the SLV ETF, it serves about 10 other ETFs, and it also serves as a major physical and derivative trading market for the UK, in which a lot of the European countries also get involved. So in that case, I've been following this. We've been seeing silver just slowly drain. And that prediction I made where people will come in instead of doing it to SLV and buying those passive shares where you can't actually redeem for silver at the end of the day unless you're one of the authorized participants, the retail shareholders can't, then most likely they were going to have to get their physical elsewhere. So they've shifted from the SLV, and now there's about a 59, 60 million share short position on SLV, not only as a lot of investors have got out investing in it, but a lot of people expect the SLV eventually to be drained of its silver, and I think maybe essentially to collapse. There's a lot of short position on SLV, and it's just basically a wholesale change based upon the information people have about the physical trade. And I think it's changing traders' minds. And I think that's where you're going to see the continued upward movement in gold and silver. They're starting to figure out the physical game that we predicted a year and a half ago. I think the rest of the market is starting to get an inkling about it. And that's in large part because we've been talking about it on our show. You've been talking about it on your show. And I think we're educating the market, and the market is starting to figure it out. And by the way, I will note that there's a lot of company executives that follow our reports on Gold Silver Pros, because I'm starting to get emails from people, including mining executives, other people in the industry, about what my thoughts are on the precious metals, and with particular regard to the movement of the physical stocks versus the derivative prices. And so I think people are starting to ask questions. I'm starting to see that behind the scenes for some pretty big market players. And so I think the awareness is out there. Of course, Elijah, we know that billionaire heirs came to Miles Franklin not too long ago and ordered $50 million of American silver eagles and gold. And you can start to see there some of those anecdotal evidence of the big orders starting to come into the market and take the physical out.
Now, it does seem like, as you're saying, we are seeing a lot of physical being drained from the market. We're seeing, record demand here at Miles Franklin. Your perspective on that, because we actually did just last week put out a video, telling people, hey, one of the major biggest wholesalers on the market right now is almost completely out of product. We just got notified of that. And so we were saying that, well, if you're looking to make, a modest or large movement into physical metal right now, we can't give financial advice. But if you're not looking for, month or more delays and huge premiums, you might want to act now. Your perspective on that?
Yeah, I think in silver in particular, if you're considering buying actual bullion, a physical product, anytime in the next 6 to 9 months, and this, I'm being conservative here because you never know what the future holds. I really want to say 2 to 3 years, but I'm not going to say it. I'm just going to say next 6 to 9 months until about the second quarter of next year, 2023. If you're interested in buying physical and you've made that choice and that's something you're going to do, I agree with you, do it now, because I do not see how much longer that pressure on physical inventories is going to be kept up by new supply. We know from Metals Focus, which provided the data for the Silver Institute's report they put out every November, we know that we're now in year 4 of having a current supply shortage from the miners to what the industry is actually demanding for industrial usage and what investors are demanding for investment product. And what has happened over the last year and a half, in particular, especially with the silver squeeze movement, is those shortages in mine supply have been taken advantage of by investors who are now gobbling up all available inventory, above ground inventory of silver. This is a major issue, Elijah, because silver is needed industrial much more than gold as a percentage. A lot of silver is used in industrial products. If the world does not have silver for industry, things start shutting down. All electronics, medical, military applications, lasers, you name it, silver is used in a lot of things. And I think that we're coming to a crisis point in which we do not have enough physical silver being produced, and we do not have enough above ground inventories, that there's going to be some sort of supply shock on the market, and companies and businesses are going to have to start making alternative plans. I think what's going to happen is they're going to start going directly to mines, maybe to get their output, much like Samsung has gone to some Mexican mining companies in the past. It's rumored that Apple and Tesla may do similar things, and they're certainly looking to secure their supply of silver going forward because electronics companies use a lot of it. But I think industry in general is going to want to secure their silver, and they may start to have to go outside the exchanges, Elijah, if they don't have it anymore. If London and COMEX cannot supply that, they're going to have to go to Shanghai. They're going to have to go to Dubai. They're going to have to go to India. They're going to have to go to the miners. They're going to have to secure it some other way. That, of course, I think is extremely bullish on prices because I don't care the fact that the OTC and the derivatives market and COMEX control the spot price. When you have a physical shortage and the industry starts complaining about it, everybody's going to flip long on those derivative products because they know that the silver price is about to rise. So I think we're in a little bit of a pocket of time here in which there's enough above ground inventory of silver that if you decided that you want some, now is the time to do it. Do not wait. Now, there could be more supplies put back on market because what happens when price rises? The miners are going to go back out and they're going to start exploring and reopening mines. The problem with that, Elijah, as we well know, is, and we cover this on the channel all the time. I go on silver mine tours all the time. In fact, next week I'm going on 2 in Mexico. What we know for the miners is it takes from 2 to 7 years to restart supply. Even if a mine is there and it has above ground product and you got to get it to a point in which you could export it to manufacturers, sometimes the facilities beyond care and maintenance takes 2 years to restart. And if you got to go find new resources and drill for it, you're talking 7 to 10 years in many cases. So I think we're in a near to medium term severe risk of a silver supply shock. The story in gold's a little bit different because most above ground supplies are still there. However, I think gold's going to go up as well because of worries, the fear contagion in the markets and the fact that central banks have been net buyers for now 12 years running. And a lot of what we would call free or liquid gold on the markets has been accounted for. There's more gold available than silver, but I actually anticipate as we have worsening economic data coming out from the rest of the country suffering from a strong dollar, which is causing us to export inflation to all these other countries, that people are going to gobble up gold. And I do expect gold to follow silver this time a little bit in terms of its price rise. But I think both are very positive, bullish factors for the metals.
When it comes to the general economy right now and what we're seeing in the stock market, it seems like we're continuing to see the stock market fall. We had seen a rally back in July, but now we're just pretty much going straight down here. Your perspective on where that is, and as you mentioned, is this just going to drive more investors into safe havens like precious metals?
I think what happened, and this is research I'm putting out at conferences on our channel, when you look at the stock valuations, there are a lot of ways to do it, but one of the more common ones is price to earnings ratio, meaning how much do you pay for what that stock actually earns? Are you paying 100 times what they earn, 1,000 times, 500 times? The overall PE ratios in the stock market are all-time elevated dating back to 1870 when you look at a ratio called the CAPE, or the cyclically adjusted PE ratio, which is a rotating PE ratio over a 10-year period. It allows you to accurately compare different 10-year periods throughout history. And if you date it back to 1870, we're sitting still, even with the runoff in stocks now, the all-time highest valuation and highest valuation away from the mean historical value over time dating back to 1870s. So yes, stocks are definitely overvalued. And so a lot of the runoff we're seeing in stocks now, I think, is more of a margin call induced or a liquidity induced event in which people just need cash. So they're selling. They're selling to protect their businesses. They're selling to protect their portfolios. They're reorganizing into other safe haven assets. I think that's why the dollar has been bid up. I do expect some of that to come into the bonds. And the bond market interest rates have been going up on the expected problems, expected interest rate increases by the Fed. But overall, there's been some downward pressure as of late on bonds because I think people are in a flight to safety there. The problem is this is the end of the fiat currency era, I think, in the dollar. And so the dollar and the bonds aren't going to be the ultimate safe haven exit out of the system as it continues to collapse. I think what's the ultimate safe haven exit is going to be is gold and silver. So I think we're seeing an intermediate stage movement into the dollar as a safe haven currency, which eventually is going to transmit into the metals. And I think we're going to continue to see weakness in the bond and stock markets as we go forward. Not only does this depend on the Fed and what they're going to do with interest rate hikes, because they said they would stop at around 4.4 and reevaluate for 2023. If they're able to make it to 4.4 without actually causing a market event in and of itself and the interest rate rises, I'll be surprised. But if they do, then we have to look at what's coming out of all the other countries in the world. Are we still having an economic slowdown? Are we still having negative GDP prints around the world? Are we still having economic fundamental issues? How are the rest of the world's central banks dealing with the inflation being exported due to the strong dollar? Those are going to be key topics for 2023, Elijah. And I just suspect that the next couple of years, most of the data coming out is going to be bullish for gold and silver. But just expect there to be a little bit of a delay and a lag. Remember, spot prices, which we often look at every day, are determined by derivative investments. Most of those investments are determined by people who are not gold market experts. We're talking about managed money and some of these others. And so sometimes there's a delay in information transmitting to trader positioning. And but when it comes, it's waterfall, because everybody will do it at the same time. All the models, all the mathematical algorithms will kick off at the same time, and you'll see gold and silver move in tandem, and you see them both move strongly. But I think we got a ways away before the big one. I think we're just going to creep up here. I think gold right now, if you look at it, is a little bit climbing the wall of worry, a little bit dating back, the dating back to the beginning of the year, but it hasn't made its big move. And I think if the Fed gets above 4%, it's going to make a pretty substantial move. And I think as we look at the economic data coming out from around the world, it's going to make a pretty substantial move. And I think that move will occur over the next 6 to 9 months. And then we'll reevaluate and we'll see where the Fed is in 2023. And we'll see what is likely to happen with the rest of the markets. And then, of course, gold would be contrarian to all of that. It's going to move in the opposite direction.
All right, Robert, it'll be very important and interesting for us to continue to track this with you. Where can our viewers find you if they're interested in learning more? And did you have any last thoughts for our viewers?
Last thoughts is just pay attention to what's going on and watch your channel, Elijah, because you guys are sort of the anti-mainstream media. You will have so many guests on that will tell the truth and do really good economic and financial analysis, as well as providing solutions for people as to what to do. And it's not just the precious metals or other. There's other content in the channel, which is very, very valuable. I would say just go to Liberty and Finance, pay attention to everything that's being put out, and you'll basically know what you need to do in the future. If guys want to come over to my channel, you can go to YouTube or Twitter and look up GoldSilverPros, or you can go to our website, GoldSilverPros.com, or you can email me at Robert@GoldSilverPros, and I'm happy to answer any questions that anybody may have.
All right. Thank you once again, Robert, for all your time today. And definitely we'll put that link to your YouTube channel in the description of this video. Thank you once again, and God bless.
Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.